And this is to show you that you can do this, that you can read a stock chart, you can interpret price action, that this is not something that is beyond you. And I'm going to show you how that's possible. And really the big mistake that people make in terms of trading and investing is thinking that you have to be super intelligent or have a ton of talent. And I can tell you that I'm neither of those. I'm not saying I'm a dummy, right? Or I'm not saying I don't have any talent, but you don't need it. Like I said, my background had nothing to do with mathematics. I was an English teacher, and a lot of people have this understanding that in order to know how to utilize the markets, that you have to know these wild mathematical concepts. And while that can help, I'm not saying that it's harmful. You don't need it. The majority of trading and investing is second grade math, right? And I'm going to show you that. So this is all about learning a language. The markets are a language, and learning a language is difficult, but it's easier with guidance. And that's where I come in, right? I'm your teacher, and I'm going to help you. We got the hands in the pile. We're going to make this work here together. So what we're going to go over tonight is I'm going to give you the framework that you'll be able to apply to both investing and swing trading. All right. So there are 5 things that are part of this framework that I will introduce those here tonight. And then thereafter, as I'm teaching you the concepts, they're going to fit in neatly to each of these 5 areas. And the goal is, I talked yesterday about how you'll leave here with the system. The goal is all the concepts that I teach you, you'll be able to classify into each of these parts of the framework. And this will really establish a foundation for you to continue to build, continue to learn, and dedicate yourself to this process. Because remember, this is not something that you're just going to do for 4 nights and you're going to go off and crush it. And maybe some of you will, and I hope you do that. But this has to be something that you're going to commit to, right? You're giving your 4 nights to this first full week of January. But I'm challenging you to stick with this and really dedicate yourself to learning it and studying and practicing. And really next year in 2027, looking back and saying to yourself, wow, look how far I've come. So that's what I really want you to do, is commit to this. And this framework that I give you is going to make it so much easier to learn. And then we're going to get into candlestick charts. So this might be review for some of you out there, but I'm going to teach you how to read candlesticks. I'm going to teach you some of the basics of candlesticks. I'll show you how to set up a chart in TradingView, how to look at stocks. And then we're going to get into talking about the moving averages, which really, in my opinion, the most important, powerful, impactful indicator that you can use. And I'm going to talk to you about 3 specific moving averages. And you might be saying, well, what the heck is a moving average? I'll get there. But they are parts of trading that you must use. It's not should. And it's the bread and butter of really my approach to trading. So we'll go over all of that, and we'll go through basic elements of TradingView. All right. And so I gave you guys some homework last night, and I asked you to think about what potentially, we talked about some of those examples with Apple stock. And, if you invested a certain amount of money over a period of time, what you could grow in 3, 5, 10 years, 20 years, 30 years. And would that future be worth it to you to commit to that? And so I just want to start here tonight to see if anybody's willing to share, if you thought about that, and is it worth it to you to learn? And that's what I want to hear. Anybody so Ben says committed to crushing it. All right. I love it. Did anybody think about that? And it could be any response. I'm not looking for anything. I'm just looking for some natural, organic responses to maybe what came to your mind, images, visions, maybe a sound. Tammy and George, generational wealth. Jason, can't afford not to. Anybody else? Don't be shy. Always committed to learn more, never stops. Yes, perpetual students, right? You have to be. After floating around for 50 years, I gotta go. It's never too late, brother. Never too late. 9/11. Yes, committing yesterday. Easy answer. More time with family is the goal. I have to leave something for my kids. Wonderful. Committing to the lifestyle that trading will demand. Lifelong learning. Now, 9 a.m. to 11 a.m. Gotcha. Yes. More giving. Dave, you have a heart of gold, man, because you've been in classes before and you always emphasize that component of making and generating profits, that giving component. So shout out to you about that. But this is all great because all these things are possible through the markets. And yes, it is worth it to you. So I'm going to answer the question for you. Yes, it is worth it for you to learn it. And it doesn't matter how small that you begin, over time, it can grow into something powerful that not only benefits you, but your children or your grandchildren. Okay. So here's the framework, guys. We're jumping in. So have those notebooks ready. We're going hard right now. Okay. So this is the framework that you're going to use. And so the way this is going to work, as I start layering out this system to you, when we get to the final night of class, everything will tie together and you'll be like, wow, I see how it all fits. But this basically here is the foundation. Each of these components, capital, trend, entry, risk, and time. Everything that you're going to do, if you utilize this system, everything that you're going to do for an investment and a swing trade will follow this process. Okay. And so this is where we're going to start. I'm going to walk you through what each of these means. And then what's going to happen is when I get into the more pointed concepts, like the candlesticks, like the moving averages, they're going to fit neatly into one of these topics. So the best way to think about this is these are the main concepts that we're going to learn that you'll need for investing and trading. And everything else that I teach you is going to fit inside of this. And that is going to be your system. All right. So it's capital, trend, entry, risk, and time. I don't know if does that spell anything? CTERT. That doesn't sound good. So I wasn't coming up with any kind of an acronym here, but if I'm just looking at that, CTER, it doesn't really work, but you get the point. I'm trying to give you something to memorize here. But let's dig into this. So what does this mean? And again, we're going to be coming back to this over time here. So when we talk about capital, the first part of this framework, this essentially means your money that you have available to you to work with, to invest and to trade. So basically defining how much and what type of capital that you're going to be using for your trading and investing. So that's what the capital is going to refer to. Now, when we're talking about capital and we're talking about investing and trading, we have to think of, okay, how much am I willing to utilize? Because we don't want to overexpose our capital to risk. And we don't want to emotionally position ourselves in something that is going to make us go crazy and lose our minds and not be able to sleep. All right. So knowing how much capital you have access to that's discretionary or that you can afford to put to work for you and you don't need it right away, you have to define that. You have to know what that is. So that's where you take stock of your capital, what's available to you. Okay. So that's the first part of the framework. Then we have what is known as trend. And we're going to talk about trend tonight because this is super important. And when we're investing and when we're trading, whether swing trading, day trading, and we're not getting into day trading in this class, we want to make sure that we are aligned with the momentum. And that's what we're talking about when we discuss trend. And we want to identify what the dominant trend is on the chart. And we're going to be looking at daily charts, weekly charts, and the monthly charts. So we'll probably look at daily and weekly here tonight. but the longer term timeframes are what you want to look for your swing trades and for your long-term investments. And what we want to determine, is it a bullish trend or is it a bearish trend? Now, I am not going to assume that everybody knows what that means out there who was with us here tonight, because that would just be foolish of me. But if you hear this term bullish, and I'll tell you this true story. Whenever I started trading, I had no clue what bullish or bearish meant. I was like, what is that? I don't get it, right? So it was all new to me. But essentially, when something is in a bullish trend, it's moving higher, it's moving up, right? The price is going up. And if something is in a bearish trend, it's the opposite. It means it's going down, okay? And here's a trivia question. I will give somebody $100 right now if you could tell me in 10 seconds, type this in here, that way you can't use ChatGPT, where did the bulls versus bears come from? It's kind of an interesting story. All right, a lot of good responses there. So close, but no cigar. So actually, back in the day, they would make bears and bulls fight each other at circuses. This is a true story. You can go look it up and research it. And it eventually found its way into the markets. And do you know who typically won those battles? I mean, that's pretty brutish and barbaric. Yes, for sure. But who do you think typically won in those battles? It wasn't the bulls. It was the bears were typically the winners. The bears were typically the winners. So there's a little piece of trivia for you guys. So I know that's a little disturbing, but I thought I would share that for you. So nobody won the $100. There's going to be many opportunities here over these next couple nights. All right. But the trend, we want to be aligned with the momentum. We want to make sure we identify the dominant trend. I'll show you how to find all that. That is going to be supremely important whenever we are setting up an investment or a swing trade. Now, the next part is our entry. How do we determine our setup? And what is our signal to get into a swing trade or to start an investment or to add to our investment? And so we want to have a proven, repeatable signal, which I'm going to teach to you guys, share with you. And we're not using fillings. And here's the thing. This is related to the whole FOMO concept. Your reason for getting into a trade cannot be, oh, I just have a good feeling about this. That's all well and good if the technicals and the charts and the momentum and all those things are lining up, if you have a feeling that's accompanying that, but the technicals and the charts have to come first. All right. You cannot trade and invest on feelings. If you want to do something like that, go buy a lottery ticket or some YOLO call options, but that is not smart investing. That's not trading. That's not what we're doing here. I want to give you an objective plan that you can use that eliminates that. Okay. This is your money, your hard-earned money. We have to protect it. We have to be conservative with it, and we can't risk it. All right. So we have to make sure that we have a plan, and we want to enter with precision, and we want to keep it simple. And that is where those moving averages are going to come into play. The next part of the framework is going to be risk. And we talked about capital, how much we have at our disposal to trade and to invest. But we also want to know, okay, how much am I willing to lose? Now, with a long-term investment, there is always the risk that you're going to lose money. However, that risk is significantly decreased if your money is allocated in companies that are of the highest quality, right? And we're going to talk about that tomorrow night, selecting stocks. And what do I mean by the highest quality companies? Your Apples, your Microsofts, your NVIDIAs, your Netflixes, your Metas. And I know I'm naming a lot of these massive technology companies, but it's also your Exxon Mobils, your Chevrons, Boeing, which has been beaten up for quite some time, is a high quality company. Even though they've had some troubling management issues over the past few years, they have a new CEO in Kelly Ortberg, but it's those types of companies that the reality of them going to zero is pretty small. I don't want to say impossible, but it's close to impossible. The difference between good stocks like those companies versus a penny stock, which is something that trades under $5, those companies can go insolvent like that. And money that you're investing or you're doing a swing trade, and let's say that some negative catalyst comes out or bad news, that stock can drop so fast in the blink of an eye that what you thought was a good setup or a good investment or a good trade, you're out thousands of dollars because you traded a garbage company. And so when we talk about risk, choosing your stocks is very important, right? But we have to define, how much am I willing to lose? For investments, you're really in that for the long game. You're not looking to pull that money out. For swing trading, it's going to be different because you have to set, okay, I'm comfortable with losing $50 every trade, $100 every trade, whatever your number is. And we'll talk about that. And you have to predefine that so that you can automate your trades, so that basically you set the trade up, you walk away, you can go do your business. And let's say that the stock drops significantly. When you have your stop loss set, you can only lose what you have set out to lose to begin with, right? So you have that peace of mind in knowing that. And a lot of people don't know that that's a possibility with trading. And the flip side of that is true as well. You can automate what your profit target is. So you could set the trade up, your stop loss, right? That's where your maximum risk is, your max loss. So if it hits that, you lose $50, $100, but you also have that profit target set. So you could set the trade up and literally not come back and check on it for 2 months. And you might come back 2 months from now and be like, I hit my profit target. I just made $400 and it took me 5 minutes to set the trade up, 30 minutes to study it and plan it out. And that's how this works. But we have to define that risk, and we're never risking more than what our rules say. And that's something that traders often have a difficult time with, is following what they say they're going to do in their trading plan. And we'll talk about trading plans as well. So that's risk. And then we have time. So this is the last part of the framework. Time is how long will I hold and how will I exit? Now, for a long-term investment, obviously the amount of time that you're in something like that versus a swing trade is going to be vastly different, because the time horizon for an investment is longer term, 10 years, 15 years, 20 years, 30 years. Versus a swing trade, which is maybe a few days, a few weeks, a couple months, maybe a year if something's really running. But those time frames are going to be different based on whether or not it's an investment or a swing trade, right? But we want to be aware of those time horizons. We want to be clear about that. And then also, too, this is something that many people don't realize. Let's say that you're in a swing trade and it's running for you and it's super profitable. You can manage that trade so that regardless of what happens, you still profit off of it and you can't lose. So those are things that you can do. You can turn a trade that has transformed into a winner for you. You could set it up so that you can't lose on that trade and you could capture more upside. So again, these are all things that we just don't know about unless we're taught them. So this is the framework. And just to go back over it: capital, trend, entry, risk, and time. So capital is how much money we have to trade or invest. The trend is, where's the momentum? Are we bullish or bearish? The entry is, where are we entering the investment or the trade, and based on what signal? Risk, how much are we willing to lose on a particular trade? And again, investments, if you're in a good company, that is really minimized. You can sit through those drawdowns. And then time, what is your time horizon for all of those? Okay. So that is the framework. And then I have this slide here for you to break it up. That's a good stopping point to see if you guys have any questions about the framework. This dog is getting his chart study in here. So he's putting in that work. He is putting in the work. I'm trying to see if you can see the ticker symbol. You can't see the ticker symbol there. He's got that dog in him. He does. He does. Look, he's got his little notebook there. He's looking at that volume. I hope he got out. You know, I'm sitting here looking at this picture. I wonder if he got out, sold at the top. Like if he got down here, he saw this little double bottom pattern come in, and he rode that thing up. I hope he got out, or he's stuck, and now he's back to flat. He's like, man, I should have took my profits. Whoo! All right, I had to throw it in there. I had to take the right. So that was heavy. Everybody feeling okay? Give me a 1 in the chat if you guys feel good about that, not too overwhelmed or anything. And if you do, that's completely fine. We have plenty of time to go back through all this. Jason, 6-7. Okay. All right. That's the first 6-7 I've ever had in one of my classes. All right. Daryl gave me a 3 - 2. Awesome. Yeah, he's probably Dave. Yeah, he's probably looking at Chewy. Yep. All right, cool. Okay, so let's keep going here. And now we are going to get into candlestick charts. And so yesterday I asked you guys to either download the TradingView app on your desktop. Ocular, I think Ocular was his name, said that you could use a web-based version. So maybe some of you sign up for a free account that way, or you put it on your phone. And so what I'm going to walk you through here first tonight is we're going to get into looking at the chart. So how do we even know what the heck a stock is doing, or how do we see information related to a stock? So I'm going to show you the basics of TradingView here tonight. And I'm going to show you the basic components of candlestick charts. And I'm also going to show you a line chart, which is typically how stocks are presented to us in the popular media. And I'm going to explain to you why candlestick charts are more important for what it is that we're trying to do with trading and investing. So what I have to do here is stop my share of the slides, and I'm going to come over to TradingView, and we are going to dig into the charts. All right. So give me 1 second to share this. And I'm going to verify that you guys can see this first, because I have had moments where I taught classes and people were like, we can't see your screen, dude. Please tell me you can see my screen here. All right, perfect. Because I don't want to be here talking and everybody's like, we can't see it. Okay. So this is TradingView right here. All right. And just let me give you some basic features that you can see here on TradingView. All right. On the right-hand side, you're going to have a watch list. And this is where you can look at any stock, future, crypto. You can look at it all here on TradingView. Okay. And TradingView really is the industry standard of charting. You have some others out there like TrendSpider, but this is the best. Okay. So if you want to look up a particular stock and pull their chart up, the way that you're going to do that is up here at the top where it says watch list. There's a button, this plus button. When you click on that, you can add a symbol. So let's look up Chewy. So Dave brought up Chewy. So if you just type in the name of your company, so we're just typing in Chewy here, you could see it'll bring up the ticker symbol. And in this case for Chewy is CHWY. You could see Chewy Inc. here. And then all you have to do is click this plus button, right? So I'm clicking plus, and then that throws it on your watch list. Now I have a ton of stocks on here. I don't recommend that when you're starting out. You want to have a handful, and we'll talk about that more tomorrow. But so let's go ahead and click on Chewy. And right here, this is Chewy's chart. Now, what we're looking at is a daily candlestick chart. All right. And so each of these candles, let me zoom in here. Each of these candles represents one full day of price action. All right. So each candle is one full day. Now, here's the cool thing about TradingView is you can have a variety of time frames. You can come up with any time frame you want. So look, if I just click here on weekly, now each of these candles represents a week's worth of price action. Isn't that cool? Now check this out. We might want to go to the monthly. Here's the monthly. If we click on the M there, each of these candles represents a month's worth of price action. And you could see here, you could set it up seconds, minutes, 365 days. You can come up with whatever time range you want because you could do a custom interval here. It's up to you. All right. But here's what I'm going to tell you for swing trading and investing, there are 3 time frames that you want to look at. It's the daily, weekly, and monthly. Okay. Now we're going to get into the parts of candlesticks here in a second. But the next thing that I want to show you is typically the way that stocks are shared in the popular media and the way information about stocks are delivered to us are through line charts. So something like this. I know for me personally, I remember when I got into trading and investing and started actually learning, the only thing that I knew was a line chart. Excuse me, guys. Like we're seeing here on the screen. This is how I'd always thought of stocks, and this is how I always remembered them, right? And a line chart is good for seeing trend, right? You can see trend, you can identify some patterns, but it's only giving you one piece of information. Does anybody know what that piece of information is and how the price action is plotted on a line chart? Does anybody know that? This is a quiz question. It's not the high or the low. It's not the average closing price. Dave got it. It is the closing price. So with the line chart, on the daily, whatever the closing price is, that's where they're going to plot the point for the line. All right. So that's only one piece of information that we're getting. And that's why the line chart is just inferior to the candlestick chart, because the candlestick chart gives us more information. And I'm going to teach you what the components and elements of a candlestick are. So here is our candlestick we're going to look at right here. All right. Now, green candle. Is a green candle bullish or bearish? What do you think? Ocular says no, dark mode is diabolical. Yeah, I can't do the dark mode. I got to do the light mode. Yep. So it's bullish. And so let me explain. I'm going to type this here on the screen for you guys. A green candle is bullish, and it means that the price closed higher than where it opened. And I'm going to show you this here in a second so you can understand it. Okay. So this candle that we're looking at is from today. So this candle represents January 6, 2026. All right. Now look at this. This rectangular part here, this is what is known as the candle body. All right. So let me type this here on the screen. Candle body. All right. And you can see that there are a variety of shapes that candle bodies can have. You can see this big, massive guy right here. They call this a bearish engulfing candle. And this one today has a pretty small candle body, right? It's not big at all. This represents some indecision here on Chewy. And we could see the bottom part of this candle body right here. This is where the price opened, right? So right here, the bottom part of the candle body, this is the opening price. All right. Got it? So the candle's color is going to be based on the open and close. So because we opened here at about $32, right? $32 even. The price pushed higher, and you can see it went all the way up here to 32.66, and we'll talk about that here in a second. But the top of the body here at 32.15 is where it closed. All right. So the top of this body, let me draw a line right here. This is the closing price. Closing price. All right. So because the opening price was lower than the closing price, that is what makes the candle green and a bullish candle. Now, even though this finished as a green candle, that doesn't mean that the price is higher than it was the day before, because we could see that it's not. It's actually lower. Well, it's very close. It's actually, it closed where it closed yesterday. And we'll talk about bearish candles here in a second. But the primary concept you need to understand here, when you're looking at green candles, the bottom of the candle body is always going to be your opening price, and the bullish candles are going to close higher, and that's the top of the candle body. So that's right here. Okay. So those are two. So that's two data points that you're getting right away that we've covered versus the one data point that you're getting from the line chart, right? Which makes this a better chart to use. Now, in addition to that, we have these two long lines coming out of the top and the bottom. And let's start with this bottom part right here. So some people will call this a tail, a lower wick. You know, there's a bunch of different names that you can use for it. We're just going to call it a lower wick or a tail. All right. Does anybody want to take a guess what the bottom of this wick represents? Ben, yes, that is the lowest price of the day. Very, very good. Great job. This is the lowest price of the day. Now, here's the thing. The bears pushed the price down. They dropped it. They got it down to 31.51, but they couldn't hold the price there. And I can see that some of you, so Shankar says this and Natalie does too, is they wrote buyers or buying. When you have a longer, lower wick like that, indicates to you that buyers are stepping into that price area and are pushing the price higher. So that's what is happening. So even though the bears dropped this down here and created this price area, they pushed it down to 31.50, the bull stepped in and bought it up, right? So this was the lowest price of the day, but the bears could not hold that price at that level. Okay. Yes, the bull stepped in. So now we have three data points from the candlestick chart. We have the open, the close, and we have the low of the day. So now, if that lower wick is the low of the day, the upper wick is the what? You guys know this. I'm just going to wait. That upper wick is what? What is it? The high of the day. Yes, this is the highest price of the day. All right. Perfect. It's the highest price of the day. And a similar concept here. The bulls try to drive this thing up. They were retracing this big bearish engulfing candle that came in the day before, but they could not hold the price action there. Right. So it showed that they really tried to push it up, but they couldn't sustain it. And then what happens is we could start putting all this information together. So we have this longer lower wick, we have a longer upper wick, and really that's pretty even. This candle is pretty even in terms of buying pressure and selling pressure. There might be a tad bit more selling pressure. And this is it's an indecision candle. Some people might call this a spinning top candle. And we're able to glean that information just based on the parts of this particular candle, right? The open, the close, and the high and the low. We could see that it's even across the board, which tells us that maybe traders and investors are waiting on some information to come in before they fully commit to pushing this in either direction. Okay. So that's what we get from the language of the candlesticks. All right. So those are the 4 parts. Yeah, doji. And for it to be a true doji, you would need no real candle body. The open and the close would have to be the same. Those are your purists, your doji purists. And then the crazy thing is if you get into the language of candlesticks and patterns, there are like 6 different types of doji candles. And then you get into patterns, it's a whole nother world. But here's the thing, you don't need all of that to get started. But over time, it's something that you want to learn. All right. So those are our bullish candles. Now, for a bearish candle, it's just going to be the same type of concept. But the difference here is that a bearish candle is going to close lower than it opened. All right. So here, and we're looking at this big, massive bearish engulfing candle. Come on, TradingView, work with me here. I'm trying to point to the open right here. So right here, this is where the price opened. So opening price, right? And for bearish candles, they open higher and they close lower. So right here is where the price closes. So this is our closing price. Let me type this in here. Does that make sense? It's just the flip of what a bullish candle is. So this is our closing price. And then here's the thing. The upper wick and the lower wick don't change. So just a quick quiz for you guys to reinforce this. The lower wick represents the what? Even if it's a bearish candle, the lower wick is the what? It indicates buyers, but it's also the low of the day, right? Low of the day. And it's not the closing price. Remember, the closing price is the bottom of the candle body. The lower wick, the very bottom of that wick, is the lowest price of the day. So if that lower wick, the bottom of the wick, is the lowest price of the day, the upper wick is the highest. It's the highest price of the day. All right. So that's it, guys. The 4 parts of candlesticks. You have the open and the close that creates the candle body. You have the lower wick. The bottom of that is the lowest price of the day. You have the upper wick, which is the highest price of the day. And those are the 4 pieces of information that you get from candlesticks. All right. And so what you could do is really just go back and look at the chart and study the price action and see how is it moving. And for instance, if we look here on Chewy, really since the beginning of November, this thing has been moving sideways, right? If I just draw a line here, it's been pretty much range bound, right? Now you did have a break above the range here on the 10th of December. There was probably some news or some type of catalyst, but you could see that got rejected and it fell right back down into that range and it's moving sideways, right? So that tells us there's a bit of indecision right now. And notice we have nothing else here on the chart. We have our candles. And let's just do this. Was that an earnings candle? Yes, it was. Great. Rajon, look at you. You're the vet, man. You're pointing that out. But if we look at this, what type of trend are we in? What type of trend are we in? If we see that the price was up here back in June, up at 48.70, and now we're down here at 32.16, we're in a downtrend. We're bearish, right? We can visually see that on the chart, right? That doesn't take an Ivy League degree to see that. And what you could do is just see, all right, well, how did this pattern move? All right, well, it had a big drop. And notice too, things aren't just going to go straight down. You're going to have these little periods of bounce in a downtrend that are called retests, right? So you have a little retest here where people are thinking, hey, this thing's going to recover. It's going to go back up. But typically when you're in a downtrend and you have a retest, guess what's coming next? You're coming down further. And then guess what you're going to get? Oh, we're coming back. We got a little retest. And then you're coming down further, right? But then eventually you'll get a little bit of relief and you'll come back up. But you can see this has not been able to hold on to any type of bullish sentiment, and now it's down into a range. Okay. Trading sideways, potential bear flag. All this information we could get from the charts. Okay. And if we really want to zoom out, so let's just go back. This is the cool thing about TradingView. Look at this, guys. We can go back to the inception of this company in 2019, right? So just think, somebody probably bought Chewy. And here's where we get into talking about the quality of stock. So yesterday we looked at Apple, buying Apple in 2019. You could have bought it for $44. Somebody probably bought Chewy, 1,000 shares of Chewy. And guess what? If they bought it at 33.87, they're down on their position 5 years later versus the person who bought Apple. It's the reason why you only want to buy high quality stocks for your investments, because you don't want to own a Chewy. You can trade a Chewy, and I'm not trying to be offensive to anybody out there who likes Chewy. I'm not trying to do that, right? I'm not saying it's a bad company, but longer term, when it comes to your investments, you're going to pick an Apple over a Chewy every time. Because look at this thing too. And there were probably people who bought here at $120. Who knows if it'll ever get back to that. But I'm going to teach you how you avoid this getting in here. All right, I'm getting off on a tangent. Does everybody feel pretty comfortable about candlestick charts and the components of candlesticks? Yes? Give me a 7 in the chat just to make sure. I just want to make sure. All right, good. And again, I know that that's probably a review for some of you, but I want to make sure that everybody has this. All right, I got another 6, 7 in there. You guys, you're jokesters. All right, that's funny. Sorry. All right, so this is the candlestick chart. So this is the basis of where we're starting. This is what's going to help us read the trend. Now we're going to add in my favorite and this changed everything for me when I doubled down on the moving averages, and that's what we're going to go to next. So now I got to go back over to my slides. Big Ben, yeah, number 7. We need some Big Ben magic on Monday against the Texans. So are there any Texans fans out there? I don't want to make this a sports-centric discussion. Any Houston Texan fans out there? They're tough. I'm a little nervous. But I think we got a shot. You got a brother-in-law who is? We got a Pats fan. All right. Hey, man, Drake May looks pretty good. He looks legit. Mike Tomlin fan. I tell you, Steelers have had 3 coaches since 1969. I'll share a quick story here, too. Why are the Steelers such a big part of my life? So I grew up in Western Pennsylvania. My grandfather was a Steelers season ticket holder from the inception of the team. And he was hardcore. He would take me to games. He's no longer around, and he would study like draft prospects, and he would study the game, and it just became something it's a hobby, it's a passion, but it's also something that I study and I love. So just a little side note, if you're wondering like, why does this guy talk about the Pittsburgh Steelers? It's just something it's a family thing. But anyway, I digress. Let's talk about what you guys came here for, and that's investing and trading. So now we're getting into one of my favorite concepts in the markets, and it's the simple moving averages. I love simple moving averages. And for the shorthand for it, SMA, short simple moving average. So let me explain to you what a simple moving average is. I'm going to share with you the 3 most important types of simple moving averages. And then we're going to go to the charts. I'm going to show you how to put those on the charts. I'm going to show you how to interpret stocks through the lens of these moving averages. And I'm going to blow your mind. So get ready, because this is going to be awesome. All right. I'm excited. Here we go. Okay. So simple moving average is simple, guys. It really is. It's the average closing price of an asset, a stock, over a specific number of periods, right? So if we're using a period that is a day and it's a 20-day simple moving average, it's the average closing price over those 20 days. Okay. Here's how it's calculated. Very simple. It's calculated by adding the closing prices for a set number of days and then dividing it by that number. And then what happens is it smooths it out into a line so that you could see, and here's where the power comes into play. You could see how your candlesticks interact with those averages over time. And that is what really gives you powerful information for your investments and for your trades. Okay. So examples, a 50-day simple moving average is the average over the last 50 days, closing prices, 200, the last 200 days. Okay. So that's what an SMA is. All right. Very straightforward. Now, here's where I'm going to teach you about the 50, the 100, and the 200. Now, you're going to have this video. All right. You're going to have the video to refer to, but if you want to take some notes, don't write down everything, but try to get some key points from this because this is important. I can't stress this enough, how important these moving averages are. All right. So let's jump into these. So we're going to start by talking about the 50-day simple moving average. All right. And this shows us the intermediate trend. And why are the 50, 100, and 200 important? I'm going to tell you why. Because your major institutions, your investing institutions, banks like BlackRock, Vanguard, throw in big name here, they use the 50, the 100, and 200 for their buys and for their sells. And so institutions, when they look at the 50, they're looking at it, and I'm going to show you this on the screen here soon. They use the 50 to determine whether or not a stock is still in a particularly strong trend or if the momentum is changing. For instance, is it bouncing off the 50 when it pulls back because stocks pull back, right? Or is it breaking through? Does it indicate that the momentum's shifting? And so it tells us about short to intermediate term institutional momentum. And remember, it's not us as retail traders and investors who move the market. So we don't do it, right? It's the big boys with their billions of dollars or trillions of dollars over the course of the year who move the markets, not us. We want to piggyback and go for the ride. So the 50 helps us identify a healthy pullback. So let's say that a stock is in an uptrend and it pulls back, which could feel scary, but it hits that 50. That could be a good entry point to go long. I'll show you that here in a second. And you can add exposure during trend continuation. So if something's in a strong trend, institutions may add to their positions at that 50. Or when they're in a position and it breaks down below that 50, they might use that as an indicator to say, we should probably take some risk off the table here because there's a chance it could come lower. And hey, guess what, guys? If big institutions are doing that, maybe you could do that. Yeah, you can, right? You can. That's where these moving averages come into play. So strong stocks will typically bounce off of the 50 as a support meaning where buyers step in. But when you get repeated closes below that 50, that indicates that momentum's weakening and you could start to see a move downward, right? So that's the 50. And we're going to look at that here in the chart here in a few minutes. All right. So now that we talked about the 50, we're going to talk about the hundo, the 100, right? This is trend confirmation. So let's talk about institutional use here. So some dude at Vanguard, right? Oh, we're at the 100. Is this a pullback or is this the start of something bigger here that we need to be concerned about? And that's what the question you need to ask when something comes down to the 100. The 100 can actually be a really good spot where you can catch great value, a good area for a bounce, and the 100 typically should hold. So let's say that something drops, it cuts through that 50. Well, that next line of defense is going to be the 100. And if it doesn't bounce at that 100, you could have some problems, right? So that's where institutions are asking, hey, is this a pullback or the start of something bigger? Again, I'm going to show you this all in the charts here in a second. All right. So this acts as a secondary confirmation level, just meaning, hey, it broke the 50, now it's at the 100. It's got to bounce here or there could be problems. And it's often tested during deeper pullbacks. We actually hit the 100 on the Qs. We actually broke below the 100 on the Qs. That's the big tech index. In the SPX, we hit the 100, I believe, in December, and we bounced there, right? So it's when you get a deeper pullback, the 100 is often tested, and it'll happen during uncertainty that's in the markets. Markets hate uncertainty, in case you didn't know that, or when there's rotation. Now, it's less emotional at the 100 than the 50 because it is such a strong support, but it's more reactive than the 200, okay? And when you hold that 100, that basically means, all right, if buyers step in at that 100, that means that the trend that we currently have, let's say we're bullish, if we bounce at that 100, that trend is intact and we can still continue to go higher, right? So really your 100 is basically your last line of defense to maintain a bullish trend. Now, if you break the 100, guess where we're headed next? Where are we headed if we break that 100? Where are we going? The 200. And listen, nothing good, nothing happens below the 200. All right, so we have our 200-day moving average. If you're below the 200, oh boy, and you're in a ticker on that one, you better hope it's a long-term investment because that could be scary. So this is what defines bull versus bear territory, and it's used globally as a risk on, risk off line. What does that mean? That means if you're below the 200, you basically want to stay away from that stock. You're risk off because it's in a bearish trend. It's in a downtrend. And stocks can stay down below that 200 for a long time and accumulate. And it could take a while for support structure and a base to be built out before it can climb. So above the 200, institutions are comfortable allocating capital. So pull back to the 50, even a pullback to the 100, they're good. But when you get below that 200, the institutions are protecting their capital, right? And that's, again, not to get complicated, but that's where using things like options can help you hedge and eliminate some of the downside. But whenever you break the 200, that's when things like big, massive sell-offs can happen and de-risking, which just means that people are unloading positions. They start to panic sell, or systematic selling, where these big institutions have, or the algorithms, you'll often hear them referred to, they have preset sell prices where if it hits a certain price, they're out. And then when all those sell orders get triggered, the price goes down even further. And so it begs the question for institutions to ask, should we be aggressive or defensive? And typically below the 200, you have to wait for the price to come back up and those moving averages start to be reclaimed so that you can get some confidence. All right. So I know some of you are probably like, what in the world is all this? So when I show this to you on the chart, it's going to make so much more sense. So now we're going to take this conceptually and look at it visually on the charts, right? So I hope I didn't lose anybody there going over that, but now we are going to make this all make sense here. As soon as I can pull up my TradingView, let me just verify that you guys can see this so that you're not saying, Jeremy, we can't see anything. All right, I gotta drink some water there so I don't sound like a horse. All right, I'm gonna pick a different stock. Nothing against Chewy. We're actually just gonna look at the SPX because this is the broader markets. All right, I actually have lines drawn on that one. Let's just go to the SPY. So this is the S&P 500. All right, so here we go. I'm going to show you how to set up your moving averages. Ready? All right, so we're going to start with the 50. So in TradingView, at the very top of your screen, you're going to see a button that says indicators. All right, I want you to click on that. Okay, and it's going to bring up this search bar. And what I want you guys to type in here is simple moving And then it's going to pull this up here. It'll say simple moving average. And what you can do, this is a little secret here. If you hover over the left part, you'll see this star. If you click on that star, it will put that in your favorites. So it'll always be there for you to access. All right. So we're picking simple moving average, right? So I clicked on it. I just clicked on simple moving average, right? So now if I come over here, it's going to say SMA 9 close. All right. And you guys see this line on the chart here? Okay. Now we just need to turn this into the 50. And I'm going to show you how I do this with style to differentiate from the 100 and the 200. So the first thing I'm going to do is click on this gear here for settings. And that's going to pull up this box. And what I'm going to do is click on inputs. And right here where it says length, I'm going to change this to 50 for 50 day simple moving average. Now, the next thing that I'm going to do is click on style. And right here, you could pick the color. For whatever reason, I always pick orange for my 50 simple moving average. And then I select a thicker line. So I select the third thickness of the line here. And then I hit OK. And ladies and gentlemen, look what we have. We have our 50 SMA on the chart. How cool is that? We have our 50 there, right? Did that make sense to everybody? And again, this will be here on the video. You guys good with that? All right, cool. Now, check this out, guys. Look here. Uptrend. Drop. And this is when Trump said that he was putting new tariffs on China right here. Nearly hit the 50. What happened from there? A bounce. Drop. We went below the 50, but what happened? You have that lower wick. What does that tell us? What happened there with that lower wick? Buyers came in, right? Buyers, we got a little bounce, right? And then guess what? We dropped and we kind of stuck right there on the 50 a little bit, but then we dropped lower. And when we pull up the 100, we're going to see that this hit the 100. But what I'm trying to show you is that stocks will respect the moving averages. You could see it here on the on the SPY. You could see it here. You could see the price stuck here for 2 days before it went lower. Here, where did it bounce? Off the 50. It pulled back here recently, bounced off the 50. These moving averages are powerful if you are patient. Yep. And we'll get to the April. We're going to look at the April sell-off right here. Yep. This is pretty scary. Yep. We're going to talk about this here in a second. Right. But this is the 50. And here's the beautiful thing, guys. Once you put that 50 on your chart, you could go click on any ticker. So let's pull up Microsoft. Oh, hey, we've got the 50 there. Hey, we want to look at Google. There's our 50, right? And just by doing this, by looking at these moving averages, what type of trend is Microsoft in right now versus Google? So here's Microsoft, here's Google. Pretty big difference there, right? Downtrend on Microsoft after a massive double top pattern. Higher high, lower high, lower high, and this looks like it's flagging for more downside, right? Versus Google, which is above the 50. And hey, we're just looking at the moving averages. You guys are reading charts. If you could look at the line, the simple moving average, and see where the price action is in relation to it, you're identifying trend. This is not that hard, guys. It's not. But we're told that it is. So that's the 50. All right. So now let's come back up here to the SPY. And somebody asked about EMAs. So EMAs, that's the, and I don't want to confuse people. An EMA is an exponential moving average, which gives greater weight to the previous day's price action. And that's a more responsive to, it's more responsive to recent data. So they're really good for day trading, but in terms of swing trading and investing, they're not going to be as powerful. There's still areas that you want to watch in terms of support and resistance, but it's more of a day trading concept. I do use EMAs, but for what we're talking about here with investing and swing trading, it's just the SMAs. Okay. So here's the 50. Guess what are we doing next? We got the 50. Which one are we throwing on here next, guys? I can't wait. Which one's going on next? The 100. Let's do the 100. So here we go. I'm going to type it in. I'm going to model this for you again. Simple. All right. So tell me this quick quiz. If I want to favorite this, what do I click on? What do I click on if I want to favorite this and have this come up? The star. Perfect. All right. So simple moving average. So here's what I'm going to do. I'm going to click simple moving average again. Bang. Here it is. I come over, click on settings. I click on input. I change the length. This one's going to be my 100. For my 100, it's always blue. I don't know why. I just make it blue. So here's the style. I always make it thicker. And so let me close this out. Okay. Now I have my 100. Now we're in business here. We are in business. Now check this out. Power of the moving averages. We just talked about this. Bounce at the 50. Bounce at the 50. It tried to bounce here at the 50, but it didn't. Where did the SPY bounce on November 20th, guys? Tell me where the SPY bounced on. It bounced at the 100. Was the primary trend held intact because it's bounced off the 100? Did the bullish trend hold? Yes, because the 100 held, right? And look at this. This is what's amazing. I'm going to show you some charts here because I get fired up about it. Look at how perfectly, let me zoom in on this. Look at how perfectly that thing bounced. And sure, it shot down there a little bit, but look at that. Is that crazy? Am I the only person who thinks that is just absolutely nuts? It's almost to a fine point. That's insane. It's insane to me. But the institutions leave behind big, massive clues like this on the charts. And again, it's not just the SPY. It's not just the Qs. It's not just Bitcoin. You can use this for Bitcoin, right? So let me do this. Let me go over here to Amazon, which just had a beautiful ripper of a day. Shout out to Jason and Rachel, which I know that they are in some swing trades here on this one. And this one is crushing, but I want to show you last year. Look at this. This was, what was this? 2024. Guys, look at these bounces. Look at this candle here on Amazon from April 25th, 2024. Look at that. Is that nuts? I do. I get excited drawing trend lines. But do you guys see how perfectly this bounced off the 100? And not every retest of the 100 is going to be that perfect, right? No, the institutions use these price areas. There are points of significance. The 50, the 100, and the 200 are the three that you want to pay attention to, right? But just look at this. This is 2024 Amazon. Boom, 100. Buyer stepped in, pushed it up, drop back down. Where did they step in? Right at the 100, right? And then right here, drop below the 100. It came back in, pushed up. Now, here's the other part. When you break below moving averages, and now you have to go back up through those moving averages, they become what is known as resistance, right? So support, and I didn't go over this with you guys, support is where buyers step in, right? So typically your moving averages in a bullish trend are going to function as supports. The flip is true as well, because those moving averages can turn into resistance, right? And this is where sellers step in. So at one point, what was once support, this 50 here, you can see that as Amazon tries to shoot back up, look at this long upper wick that comes in here and pushes that price right back down off of that 50, right? That becomes resistance. So that does happen as trends change. But one of the things I'm going to ask you guys to do is, now that you have TradingView, and when you set your moving averages up, go back and look at the charts. Go look at those companies that you love or that you want to own, and look at how they interact on with those moving averages, right? Right. We can see here after this is the flash crash of 2024, big drop on Amazon. There was fear about an uptick in unemployment. And then we got back up above the 100. You can see that the 100 served it as a bouncing spot again, right? So again, these moving averages are powerful. And there's a reason why I'm spending so much time on this with you, okay? Now, we've got one more moving average to add. What's the last one that we have to put on here? The 200. All right, so here, let me model it for you. Clicked on indicators, simple moving average. We hit the star. So I'm going to click it again. Bang, there it is. I'm going to come over here, click on the gear, inputs, the length. We're changing it to 200. And guess what color I use for my 200? What color do you think I use for my 200? Nobody cares. I'm just asking. It's red. All right. It's red. And I'm going to try to move faster because I know we're going long here, guys. All right. So now we have the 200. There it is. All right. Here's the 200. And somebody asked about April and the sell-off in April. Well, real fast, with the moving averages, when we're above all of them, we're in a bullish trend, right? We're above all of them right now. Markets are all-time highs. We hit new all-time highs on the SPY today, right? But you could see here, back in February of last year, we started this downtrend off of Liberation Day. We actually broke below that 200. You could see that they tried to bounce it here on March 7th. You had some buyers step in, but it couldn't hold. And then it dropped. And then what did we just talk about? That when you get below moving average and then you push back up into it, that moving average becomes what again? It becomes resistance, right? It becomes resistance. So when it drops and the moving average is now overhead, that's considered a resistance and it's got to break through. So you can see that that 200 serves as resistance here and it drops it lower. And again, nothing good happens below the 200. And you can see that when it got rejected off that 200 again, it dropped. And then we talked about the concept of a retest, and then bang, everybody thought the world was ending, the market was over. But what's crazy is this was only, I think, a 21.7% drop. 21.4, so give or take a few percent. But that was scary enough. And anything over 20% is considered, from a technical perspective, bear market. Okay, so that's our 200. So now you have those three moving averages. Yes. So somebody asked, does it mean anything when the moving averages cross? It does. You have what are known as the golden cross, which is where the 50 crosses through the 200 right here. And that can be an indicator of an upside move. But then you also have when the 50 crosses down through the 200, which is known as the death cross, right? But they're a bit lagging in terms of being an indicator, meaning that you'll typically see the cross happen. Specifically with death crosses, from my experience, when you get a death cross that happens, the down move isn't fully over, but it's close to being almost complete. But yeah, so, and there's a bunch of different types of crossovers that occur, but I wanted to make sure that you guys have these here on your charts. And again, above all the moving averages, bullish; below all the moving averages, bearish. And we are going to use this in the system that we're setting up when we talk about the framework that I went over with you guys earlier. But now you have these on your charts. And if you didn't set them up as we were going over this, then tonight or tomorrow, please put these on your charts and just start experimenting and looking at, all right, how did the stock interact with these different price areas? And you could see, and what we're going to get into tomorrow is, okay, this is all great information, but how do we use this for our investments and for our swing trades? And that is what I'm going to be showing you tomorrow, because you don't want to buy here. You don't want to buy at all-time highs. When you're investing long-term, you want to know where to buy. The moving averages show you where to buy, right? So we're going to cover all that. So now let me come back to my slides. I know we've gone long here, guys. And I wasn't anticipating going this long, but the movement got me, right? The moment got me. So trend identification and looking at those moving averages. So bullish, the price is above all three of them, your moving averages, 50, 100, 200. Pullbacks are normal into the 50, into the 100, nothing to freak out about. When you break below that 100, that's where you've got to be cautious and watch to see what's going to happen. And you want to start de-risking, because if it gets down to that 200 or below, like I said, nothing good is going to happen there. Neutral trend. If the price is in between, kind of smacked in the middle, then it's a neutral trend. It's indecisive. It's trying to figure out what it's going to do. Meta right now, I believe, is slightly above. Let me check that one, because that could be a good example for you. Meta is okay. So Meta right now is above its 50, but the 200 is slightly above it, but it's been kind of moving sideways. It's been in a downtrend forever. So I wouldn't say it's in a neutral trend, but if it can get above that 200, it'll then be above the 200 and the 50, and it just has the 100 above it. And typically when you have those neutral trends or things moving sideways with the averages flattening out, that tells you that a bigger move is coming to either direction, to the upside or downside. And that's where we use other things like volume, chart patterns. If there are certain catalysts coming, economic data, that could tell us which way it's going to go. And then a bearish trend, the price is below all of the moving averages. You're below the 50, the 100, and the 200. And when you have rallies, they often fell when you retest those SMAs. So that's how we identify the trend with those moving averages. So tomorrow we are going to talk about how this fits. So this was a lot, I know, but I'm going to show you how this fits into a repeatable framework. Okay. And not just reading charts, but we're going to build a process that you can trust and actually implement. And I will say this. So when you finish the class, and I'm so glad that all of you came back for night number 2, be here tomorrow. You've done 2 nights, but once you have the system, the next step is not just to go live with this right away. It's to practice it, right? Simulate it. And I'll show you how to paper trade before we're done. And then once you get some data, then you could go live with it. Again, you got to protect your capital and make sure you know what you're doing first. But I'm going to give you that framework and give you the steps to do that, so you have something that you are ready to work with, right? So our recap, we went through the framework for investing in swing trading. We're going to keep building that up for you. I'm going to show you how to actually use this tomorrow. You went over candlesticks with me and their fundamental characteristics. You can identify all the parts, you know why they're stronger than line charts. You went over a in-depth discussion of the moving averages, the 50, the 100, and 200, which are tremendously powerful. And we went over some basic elements of TradingView. And we're going to get into discussing companies and knowing what to trade and which companies to invest in. And so a homework question just to think about, and we'll talk about this tomorrow, is what makes a great company to invest in or to trade? So what are the qualities of great companies where we should park our money? So I want you to think about that, and we'll hit that for tomorrow. So we're going to stop there, and I'm just going to open it up to any questions that you have. I know that I couldn't get to everybody's questions, so I'm sorry, but I'll try to hit some of those tomorrow here. And let me catch up here. I'm sorry you can't make it, man, but I will send the video out for you guys so you will have access to it. I appreciate you being here. How do you use the tool to see how much the percentage drop or rally? Yeah, so let me just show you real quick. So share. So it's right here, this ruler measure. If you click on it and then pick the point where you want to measure from the high to the low or low to the high. So let's go from this high on Meta to this recent low here. And then it'll just show you right there, 27.09% from its high in August to its low point in December. All right. So that's just right over here, left-hand side measure. All right. Josh, I'm not real smart. I understood almost everything. You're probably beating yourself up too much, man. Don't Don't say that about yourself. I'm sure that you are more than capable of learning this stuff. And guys, we haven't really even applied the system yet. So it's all going to make sense. If there are parts where you're saying, well, like, what do I do with this? Like, how do I trade? That's coming. Okay. So we're going to get into all that. And don't forget the final night, somebody's leaving here with $1,000. And I do have a couple other prizes that I'm going to be giving out. So there will be, a couple cool things coming. So just be here. Just let's keep the consistency going. And so, okay, trading platform that I use. So when I give you examples of setting up investments and trades, it's going to be through Interactive Brokers because that's what I use. I don't use Thinkorswim. I'm sorry. I do have Robinhood for just some separate side accounts that I have. And that's where I started trading. And listen, Thinkorswim is awesome. Robinhood is awesome. Webull is awesome. They're all great. I just use Interactive Brokers. So my examples will be through IBKR. All right. And I love it. A lot of people hate it, but it's just super reliable. Their customer service is great. So that's what I use. So yeah. So Dan says maybe upcoming, but where to start with putting money in it. I'm going to go through all of that with you guys. I'll cover all of that. So yeah, there's so much more that I'm going to share with you guys. All right. I'm just making sure I didn't miss anything. Yeah, there's tons of videos out there in terms of using TradingView. Yep. Okay. All right, guys. Well, I kept you late. Thanks for sticking with me. I really appreciate it. I hope you have a phenomenal night. I'll see you here tomorrow. I'll try to be quicker tomorrow because this was like 2 hours, but I get fired up. And you guys, listen, you guys were awesome. So the engagement here, love it. This is the most engagement I had in a class. So you guys are killing it. So thank you. I'm not gonna be able to go to sleep now. I know that. All right, guys. That's it. Take care. I'll see you tomorrow. Rock on. Have a great Wednesday. See you, everybody.